Hello everyone, this is Mark with Semantics Trading with a quick video on auction market theory. You can think of the market as a two-way auction process. Let's pretend that you're searching for an item on eBay. The seller would often offer the item for a certain price, and the buyers will bid it up higher and higher until there's no more buyers. A majority of buyers are willing to purchase at a fair price, which is essentially the price that most are willing to pay. A seller could have a price set at, let's say, $100, but no one wants to buy it. So the seller lowers the price to $99, $98, $97, until it reaches a price which buyers deem fair to start bidding. Let's just say this price is $95. When it hits the price of $95, it acts as an advertising mechanism which attracts buyers in. From then on, they will start beginning to offer bids up until buyers get exhausted and there is no interest in purchasing any higher. The price may even rise even above $100, as this excitement has given buyers initiative to start showing interest. When the auction slows down and gets temporarily exhausted, it can either do two things. The first option is that it could slow down and stall and begin falling back to fair value if buyers deem it overpriced, or it could consolidate and then continue moving higher due to an emotional response or motivation that gives a perception that price is still a very good deal. An important rule is that you should never ever assume that price is too high or too low, as the fair price can move up or down depending on the perceived market value. For example, you may not be willing to pay $100, but other people may consider it a good deal and buy it up. Sometimes there can be factors in the market which people will buy at fair value or sell below fair value. This is due to emotional trading, and people are not thinking rationally, but rather something has caused them to panic and run to get out of the door. You can think of it as a movie theater which, when it's on fire, the exit remains the same no matter how crowded it is. In the market, higher prices always drive new activity. You can say that price is a sort of a advertising mechanism. It's like you walk by a store every single day and see the same TV for $100. You keep passing by the store each and every day and the price is still $100. But one day you notice that the price is $80 and then you want to buy it because you see a dip in price. I mean, why wouldn't you seize this opportunity to get a great deal on a TV? This is the same concept on the market profile, where we see price hovering above the point of control, and whenever it deviates, we take it back to the fair price. Always remember that the price is nothing more than an advertising mechanism for the market, and sometimes the price will reach a higher price instead of going higher, it will drop lower. So we don't necessarily focus on price, as it's quite of a bad influence on our mentality. It's better to become more of a machine of sorts that trades solely on real-time data and ignore any irrelevant, usually FUD news or impulses that you may have heard. The only news that really matters is big news that really reflects macroeconomic data or some sort of nasty surprise, let's just say, for a company, or let's just say a company is filing for bankruptcy, or something drastic of that sort. That generally drives that's generally a very relevant set of news. But anyways, the motives and incentives that drive buyers and sellers are virtually infinite. There's no real need to figure out why price is moving up or down, but rather concentrate on the data. Regardless of all these factors, the only thing we should focus on is being rational and acting upon the market data that is telling us what is going on at that very moment. This auction market theory is a theory that ties and explains the inner workings of any market, whether it's a stock market, baseball card market, commodities market, you name it. Now, they all vary in liquidity. Usually, bonds and stocks are the most liquid, with real estate being less liquid, fine art even being less liquid. But they all are driven by this sort of theory, and they all follow this principle that is highlighted by the auction market theory. But that's pretty much it for today's video. I want to thank you all for watching, and be sure to subscribe if you find these sort of educational videos helpful. This is Mark with Semantics Trading, signing out. Thanks again.